Welcome to the first of a series of Express videos related to the paper of Foundations in Audit being part of ACCA's FIA qualification. I would like to draw your attention to the fact that our videos are not supposed to cover the whole of the syllabus, and they do not contain any question practice. In the case of exam preparation, the question practice is extremely important, and therefore these videos cannot be considered the only source of your preparation. Now, what I suggest you do is you open the Express notes. You can download them from the website www.theexpgroup.com, because this video will be based on the content of the Express notes. Now, in this first video, we will talk about the business environment and audit framework. We will talk about what auditing is about and why it is important to have an audit. To start from the big picture, now audit is all about trust. Investors make their decisions about buying or selling shares, and they want to base those decisions on information that they can trust. They usually base on the financial information that companies provide in the form of financial statements. Now, they must be sure that what the financial statements say is true and fair. This concept of truth and fairness in the financial statements will be coming over and over again to our attention during your audit studies. Now, companies operate from day to day, and at the end of the year they prepare financial statements. Now, there must be someone who will confirm, who will provide assurance as to whether those financial statements are true and fair. People who do that are accountants that are called auditors. Auditors perform their procedures on the financial statements in order to provide assurance. They provide something that is called reasonable assurance, in contrast to an absolute assurance, and that is simply because there is absolutely no viable way of checking everything in the financial statements, all the transactions, all the balances at year end, simply because they are a product of work of tens of or hundreds of accountants throughout the year. Now, the role of an auditor is important because auditors provide assurance. Now, in order for this assurance to be trustworthy, there are some strict requirements and expectations of auditors of what they should present themselves. The most important of those requirements is the requirement to remain independent of the company they audit. Now, whenever there is a problem with independence, or whenever there is a problem with the conduct of the auditors, that leads to a problem for the company that is being audited. Some of you may still recall a company called Enron. Enron was a subject of a big corporate scandal back in 2002. Apparently, the managers of Enron manipulated the financial statements of that company in order to present results that were better than in reality. Enron's auditors were Arthur Andersen, who apparently did not spot those manipulations. Because of that, Arthur Andersen lost trust of their clients and went bankrupt. Enron went bankrupt as well, and investors who placed their savings in the shares of Enron lost millions. Sometimes they lost their pensions. So auditors provide trust, and in order to do their job properly, they must meet certain qualities, and they must remain independent. Now let's look at a broad picture of how the situation looks. Owners, or shareholders as we might call them, are the ones who own the company. They may have set it up, or they may bought into it later on. They usually don't manage the company themselves. They hire the managers to do it. The company is managed by the managers, therefore, and the managers work on behalf of shareholders. The remuneration of the managers usually depends on the financial performance of the company. The managers are supposed to increase the wealth of shareholders, and therefore they're supposed to manage the company in such a way as to maintain its stable financial position and to make its financial performance better and better. The way shareholders assess the financial position and performance is by reading financial statements. And now please look at a tiny conflict here. Managers' jobs and remuneration depend on the financial performance of the company. Yet the way the shareholders find out about the financial performance of the company is by reading financial statements that are prepared by the managers. We're not trying to say that the managers are always trying to manipulate financial statements. In the majority of cases, this is absolutely not the case, because the managers that were hired by the owners were usually hired because they are people of high ethical standards. But just to be able to remove that conflict, just to be able to increase the level of trust, the owners hire auditors to just check that what the managers say in the financial statements is true, that the financial statements are free from material misstatement. Now again, why material misstatement only? Well, that is because the auditors cannot possibly check everything. Consider a multinational group, the financial statements of which are a product of millions of transactions. There is absolutely no way to re-perform all postings, to check every single presentation, the presentation of every single transaction and event. Therefore, auditors apply certain procedures. They test the financial statements in order to provide reasonable assurance. They don't provide absolute assurance, because to do that, they would actually have to check every single transaction. And that would take a lot of time, and shareholders want the results quick after year end. So they will perform their procedures, the auditors will perform their procedures, they will do some tests in order to provide a reasonable assurance. And that reasonable assurance will say that the financial statements are free from material misstatements. Again, the auditors are only concerned with material items. Material items are those the misstatement of which could change the decision of shareholders. So if there is a material misstatement, shareholders might change their decision from buy to not buy shares, or from not sell to sell. These are the changes that the auditors must be aware of. If there is an item, the misstatement of which would change somebody's decision about the shares of the company, that item will be material, and auditors are responsible for making sure that such material misstatements will not happen in the financial statements.